All right. Good evening. It's Ashley Murphy from Arete Wealth Strategists Australia. Looking forward to speaking with you tonight about what happens with your superannuation when you move to the US. Okay, so let's get on with the show, shall we? I shall press the present button, and here we are with our title slide. What happens to your super when you move to the US? Okay, I want to be really clear that tonight is not financial advice. Please do not make irrevocable decisions based on what you hear tonight. I am neither a CPA nor a tax attorney, and if there is any single area within the domain of subjects that I cover where there is disagreement, this is absolutely it. Many fine minds come to different opinions about how the tax treatment of superannuation funds should work from overseas. So please note that. Okay, so a little bit about me. I am a tri-citizen of Australia, the US, and the United Kingdom. Was educated in Brisbane, Australia, moved to the US in 2005. I've been a financial advisor since 2010, and we launched Arete Wealth Strategists in 2014, along with a sister brand, Arete Wealth Strategists, a year before that. So essentially, the Arete Wealth Group consists of these two entities you heard me mention. We're fee only, which means we act as a fiduciary 100% of the time. We're cloud-based and use very strong security for every application that we use. We offer virtual and in-person service with an office presence in Minneapolis and San Francisco. Arete Wealth Strategists Australia focuses on working with Australian expats in the United States and American expats in Australia who satisfy the wholesale client definition that ASIC has. Essentially, we're applying global investment management and financial planning services for these individuals. Arete Wealth Strategists, we focus on US business owners and executives. So you might say a super specialty that we have is Australian expat business owners or executives. Okay, here's a list of the kinds of services that we provide or provide referrals to. We work with a number of CPAs, tax attorneys, insurance brokers with expertise in international matters, and other professionals. So the different types of Aussies, this is something we recently created to describe the three different phases that we see of the expat. And that is, there's the short stay, that the individuals that are really on a working holiday, or they know that they're, if it's not a holiday per se, they know they're here for a defined period of time. There's the domicile uncertain, that is the folks that are over in the US or in Australia, got a great job, perhaps there's some uncertainty as to whether they'll stay or not, and they're just going to wait for life to unfold and help them make a decision. And then, of course, there's the permanent movers, those that have maybe started a family or fallen in love, and they're calling either Australia or the US home from here on out. We really focus on working with the permanent movers, and to a lesser extent with the domicile uncertain. Okay, in terms of service tiers, this is how we work with the three different types of Aussies that you saw just a moment ago. We work either on a situational basis, that is providing a statement of advice to answer a specific question. We provide comprehensive financial planning on a subscription or project basis, or the top tier of service we have is comprehensive financial advice and global investment management. And that's what we refer to as Wealth Fusion there. And with Wealth Fusion, for every $100,000 of assets that we manage, we reduce that monthly subscription fee by $50 per month, up until $350,000 of assets under management, when that fee is, that separate fee for comprehensive financial planning is eliminated altogether, and there is just an asset management fee. Okay, so let's talk about the outline of tonight's presentation. So we're going to talk about superannuation. What is it? It changes a lot, and we're going to give you some up-to-date information there on contribution types, the three important ages that we need to pay attention to. We'll talk about the tax treatment of super from both the Australian and the US perspective. The US perspective, going into a little bit more detail about what a foreign grantor trust is and what an employee trust is and how that taxation differs. We'll take a brief look at something I'm very excited to have been able to deliver. Thanks also to my trusty paraplanning associate, Kellen Enright, for his help in getting this going. But we've recently been able to bring a global investment reporting solution online that we're extremely proud of. We'll look at lost super, and that will round out tonight's presentation. So let's look at the different contribution types. Superannuation is really contributed to in two major ways, or there are two broad contribution types. There's what are called concessional contributions. These are the tax deductible type, very much like your tax deductible 401k contribution or traditional IRA contribution. As of 2018, there is the 2017-18 tax year in Australia, there is a $25,000 annual contribution limit to any one individual. Now that contribution may be made by really one of two actors, and we'll mention that in the next bullet point. One giveaway that the government has provided in reducing the concessional contribution limit, it was previously $35,000, was to introduce this 5-year carry forward rule for unused concessional contributions. So if someone found that there was an amount that had been unused as a result, probably, of their superannuation guarantee payment having been made into their account, then 5 years henceforth from 2018, you can't go backwards in time and try and use this carry forward rule. But 5 years from now, should you have not used that amount, then you may make a concessional contribution and have that be tax deductible. So superannuation guarantee, that is the 9.5% contribution that one's employer makes on their behalf on their ordinary time earnings. Now, not everyone will have 9.5% of their ordinary time earnings equal $25,000, and that is that surplus I was referring to a moment ago that would allow someone to contribute extra, essentially make an extra tax deductible contribution. Okay, so you mentioned, you recall a moment ago, I mentioned there are really two actors that may contribute to one's super account. That would be your employer, or secondly, yourself, through either a salary sacrifice arrangement with your employer, or as of very recent, the personal concessional contributions. And that is a lot simpler than a salary sacrifice arrangement, and that's essentially where you are making a tax deductible contribution to your super fund. Then, of course, there are non-concessional contributions. Now, this is the non-tax deductible form of a super contribution. You might think of it like a Roth. Very, very similar. In the US, your after-tax money, you would contribute that to a Roth and it grows tax-free. Same with a superannuation account for an Australian resident. Note, I said for an Australian resident, is it tax-free? Okay. So there's an interesting rule here. It's called the 3-year bring forward rule, which would allow you to make as much as a $300,000 contribution in 1 year, but that of course would cap you out for the subsequent 2 years. Okay, 3 important ages to be mindful of. There is your preservation age. Now, preservation age is, I've got the ages right here. It really depends on your date of birth. So if you were born after 1st of July 1964, 1st of July, of course, coinciding with the Australian taxation year, then your preservation age is age 60, in which case there's really only 2 years of interest. So for many folks, existing clients of mine and prospective clients, the preservation age is still relevant. So what can you do at the preservation age? We'll talk about that in a little more detail in just a moment, but that would allow you to take what's called a transition to retirement income stream. Now note, income stream, not lump sum, that you are not allowed to take that as a lump sum before age 60 and your preservation age. But you are allowed to begin to take an income stream, and there are rules governing the maximum amounts that you might take, of course. Now, over 60 is interesting. If you do not pass the work test, you're over age 60, you're permanently retired, then you may access your super account balance via income stream or via a lump sum, but with some what's called cashing restrictions. So it's up to, I believe it's $200,000 that you can access from your super account with no tax consequences in Australia. And then above that, it's, I believe it's your marginal rate with a 15% tax credit against that. Over 65, you've satisfied a condition of release. There is really nothing you need to worry about. You're going to have tax-free income streams and tax-free lump sum withdrawals. Now, this is certainly worthy of some explanation. If I had more time, I apologize. I would have made this, I tried to make it a little simpler, but we're dealing with very complex material here. So the best place to start here is, are you still in Australia? Now, presumably most people on tonight's screen sharing session will say no to that answer. So they'll say no. Were you in Australia as a temporary resident who has permanently left? Again, most people say no. The majority of folks on tonight's call are Australian citizens, and so that's why I put this little flag here. You may as well start right here. Have you met a condition of release? Let's come back to that momentarily, because this whole side of the chart is handled with a yes answer to that. So in other words, if you were a temporary resident in Australia and you have permanently left, then you would be able to access your super fund through what's called a Departing Australia superannuation payment. Now that gets people excited to hear that they can access their super funds, but what that quickly changes when you come to understand the magnitude of the tax that is due on these payments. So it's quite substantial. If someone was there if they're basically on a working holiday visa, they're going to cop a 65% Departing Australia superannuation payment. Quite substantial. And other visas would be depending on the taxable component of the super fund. I'm not going into that tonight. It's going to range between 35 and 45%. Okay, so that deals with everyone over here. Now for Australian citizens who have permanently left, we need to ask, have you met a condition of release? Again, superannuation, very complicated. There are a number of condition of releases, but mostly they're very strict. We're talking about terminal illnesses, severe financial hardship, disability, these kinds of things. Most people are not going to satisfy a condition of release unless we're talking about the age-based and work test-related conditions of release. So, have you satisfied a condition of release? No, simple as that. Got to wait until you do. Okay. Have you satisfied a condition of release? Excuse me. Have you reached your preservation age? Yes. Well, then the question, you can access a TTR income stream if you have reached your preservation age. If you have reached your preservation age, no, other tax treatment applies. So that's to say, have you met a condition of release, but you haven't reached your tax age? That's what I was referring to a moment ago. Severe financial hardship, terminal illness, that kind of thing. Different tax treatment. Consult an Australian financial advisor or CPA. Okay, so have you reached your preservation age? Yes, you can begin to take a TTR, transition to retirement income stream. Are you over 60 and still working? So, excuse me, I kind of jumped the gun there. Are you over 60 and still working? No, that's to say you're not over 60 or you're not still working. So if you are between let me clarify this, if this particular link in the chart is ambiguous, it would be if you are between your preservation age and age 60, you may access a transition to retirement income stream. And if you are over 60 and still working, okay, if you're over 60 and still working, I'd say yes to that, you're still working. Again, if I had more time, I would clean this up and make it a little more logical. Wait till that gets out of the way. If that is the case, then a condition of release has not been met, if you're between age 60 and 65 and still working, then you haven't satisfied a condition of release. So you're not accessing your super at that time. If you are over age 60 and not still working, then you may access, as you began to hear me say on the previous slide, you may access your income, an income stream or lump sum, but with some restrictions. Okay, and last but not least, you see the checkered flag here. If you're over age 65 and still working or not working, it doesn't matter. You've satisfied a condition of release and may access your superannuation account with no penalty taxes. No penalty taxes. So that's very, very straightforward there. Okay. Next, we're looking into searching for lost super. Always a good place to start before we get serious about how we're going to access our super funds. Let's figure out what we've actually got. Of course, like many have experienced in the US, there are people change jobs and get a new super account, and goodness knows whatever became of that old super account. That's where I would encourage you to go to the ATO's website. They've got a form here. If you prefer paper forms, then you may come here and fill out a paper form, and they'll help track that down for you. Or, excuse me, let me just present that again. Or you can go and create, if you're more comfortable with the internet, and presumably everyone is on this presentation tonight is comfortable with the internet. Not that it's especially complicated what we're doing, but if you create a MyGov login, then this other government department will go and track down, in fact, they'll perform a variety of services, but they'll go and track down your lost super funds for you. Okay, now here is where what you came for really begins: the tax treaty and the savings clause. So I'm going to exit the presentation mode just because there's a number of different slides that I'm going to have to look at here. So here we are. This is, I'm going to go to the top of the page, top of this PDF. This is the double taxation treaty between the United States and America. It's almost 35 years old, signed by President Reagan way back then, and I believe it was Bob Hawke in power at that time. Here we are, George Shultz, Ronald Reagan. Okay, let's cut to the chase here. What interests us is Article 18, to do with pensions, annuities. We don't care so much tonight about alimony and child support, but pensions and annuities is where it's at. Let's have a look here. So, okay, pensions and annuities. All right, so first point we have here under Article 18 is subject to the provisions of Article 19 to do with government remuneration, pensions and other similar remuneration paid to an individual who is a resident of one of the contracting states in consideration, past employable, shall be taxable only in that state. How do we read that? Essentially, if you worked for the government and your super account was accumulated as a result of governmental contributions, then you may claim exemption through number one here. That would be very good news to a number of people. Now let's look at number four. Number four has the cause of much premature excitement. Number four, pensions and other similar remuneration, i.e. taking money out of a retirement account, I imagine they means periodic payments made by reason of retirement or death in consideration of services rendered. Okay, now that would be the clause that applies to withdrawals from a superannuation account. Would you agree? Well, I would, but here's the thing. Unfortunately, there exists in this particular tax treaty what is referred to as the savings clause. Savings meaning it saves the US from the loss of taxation. So here we are. If blah, 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 electing under its domestic law to be taxed as residents of that state and by reason of citizenship and taxed citizens as if this convention had not entered into force. In other words, The savings clause is saying that this tax treaty does not apply if you are a US citizen or permanent resident. Okay, and of course there's more detail here, but tonight is not about getting into that detail. Okay, however, the provisions of paragraph 3 do not apply to paragraph 2 or 6 of Article 18. Let's go back and refresh our memories. What were Articles 2 and 6? 2, Social Security payments. Okay, that would mean, to my reckoning, and many, as I mentioned, many intelligent minds differ on this point. There are tax attorneys who, as I alluded to a moment ago, that do take a different point on this. I would deem Social Security to be, namely, aged pension in Australia, or, as the name would suggest, Social Security payments in the US. So taxable only in the contracting country that is paying that particular pension. And then the other the other item to be exempted is to do with alimony, which is to say, unfortunately, that this item 4 does not apply to US citizens or US permanent residents. So, with that in mind, let us return to the presentation. Okay, so we've looked at the treaty, we looked at Article 18, Provision 4, to do with pensions, and we saw that the Savings Clause essentially exempts US citizens from Article 18, Item 4. Okay, so that's bad news. That means that US citizens and permanent residents will be subject to US taxes on their worldwide income. So US treatment of superannuation. So how does the US treat superannuation? Well, let's have a look. So under US law, a trust is a foreign trust unless both of these conditions are satisfied. A court within the US exercises jurisdiction, and one or more US persons have the authority to control all substantial decisions of the trust. That's pretty simple then. That would mean that you could see that certainly, I'll take that bullet point back, certainly that all superannuation accounts therefore are a foreign trust of one kind or another. Okay, what's a foreign grantor trust? Well, the definition here of the grantor trust is where there is the ability of the trustee to has broad authority to determine investments or revoke the trust. And the distributions are solely for the grantor, i.e. the person making contributions to the account, or their spouse. Now, it's generally agreed that self-managed super funds or accounts with some degree of non-employer contributions fall under this definition. Self-managed super funds are an interesting animal in that you must be a resident to be a trustee of a self-managed super fund. So therefore, if you're not a resident, you can't be a trustee, you can't be a member. Therefore, it's done and done. So self-managed super funds do not apply to non-residents. There are ways, and we assist clients in devising ways of still holding alternative assets within superannuation accounts, but you cannot do it through a self-managed super fund. So it's a tax treatment of a foreign grantor trust. Essentially, you must declare, it is very bad news, and it's very unfair, I must add, you must declare all contributions as taxable income from the time the account holder became a US citizen or permanent resident. So that's pretty harsh. That is to us, and the reason I underlined all, that means salary sacrificed or personal concessional contributions. In order to stay compliant, such that one doesn't have an enormous tax burden due upon distribution of the superannuation account, professionals encourage you to file an annual tax return, reporting all contributions on line 7 of your 1040 as taxable wages. And you can't, because it doesn't meet the definition of foreign earnings, you also can't use the exempt foreign earned income. So that's a double whammy. So that's a foreign grantor trust. It's at this point, and I'm going to say it again, please seek professional counsel from a tax attorney or a qualified CPA who has an expertise in these areas. We certainly do not hold ourselves out as legal practitioners or experts in these matters. We hold ourselves out only insofar as being able to make a referral, knowing when to make a referral to such a qualified party. Okay, a foreign non-grantor, otherwise referred to as an employee trust. It's a foreign or domestic trust that doesn't meet the requirements of a grantor trust, therefore has no owner, and will be considered a non-grantor trust. The tax treatment of such a trust is slightly better, and that's to say that any salary sacrificed or personal contributions would not be taxed. Nevertheless, employer superannuation guarantee payments, the 9.5% we looked at earlier, would be taxable income. And of course, much like the grantor tax treatment, it's taxed at your US marginal rates and not at trust rates. Adding an entirely new dimension to this situation is the passive foreign investment corporation status of your super funds. Yet again, you heard me say it a moment ago, there are many professional minds that differ on these opinions, and I have to refer you to them with regards to how you want to approach this. Kind of depends on your risk tolerance and what risk factors you might be comfortable holding. So here's the conclusion that the expert counsel that I have consulted on this matter has said. Normal PFIC rules apply. Normal PFIC rules apply. Now, what exactly that entails will be the subject of a future webinar. So stay tuned for more details about that. But this adds a whole nother dimension. Not only do we need to be worried about the contributions and the tax of that, but also the actual investment disposition of the super account itself. If you're not in Australia, if you're not an Australian tax resident, you need to be mindful, and if you are a US tax resident, then you need to be mindful of the PFIC status and how you invest your super funds so as to avoid additional tax complications that may arise. In brief, however, a PFIC is a foreign company or trust that meets one of the following tests. More than 75% of its gross income is passive, i.e. a mutual fund or a superannuation fund that is not a direct stock or bond holding. And 50% or more of the assets produce passive income. So yet again, that would include REITs or other such entities, mutual funds, managed funds, superannuation funds, anything that is a pooled investment vehicle that satisfies either of those tests. Okay, moving on. And this is a real change of pace here, but one thing I alluded to at the outline of the presentation tonight was to do with something we've recently been able to accomplish that we're very proud of, and we're one of the very few investment managers able to do this that we know of, and that is a professional tool that we recently were able to get to perform this, and we're working with Morningstar, who's the provider of this tool, to enable global aggregation, meaning automatic aggregation. We're able to manually enter it currently, but what we're able to do for clients is report their global holdings in local currency and actually identify those local holdings. So in the example of this demonstration we see right here, this is a client who has accounts in multiple countries, and we're able to aggregate that all into US dollars. And then, as you can see on the next slide, report on the individual, in this case, superannuation PFIC compliant holding that we have here in Australian dollars. So that's very cool. Downloads that you might be interested in, we're actually releasing a new website. It should be out any day now, and I'm very proud of its design. It's very fresh, very logical, and contains some content that that we've been working on that's specific for Aussie expats. So we're after each one of these webinars, give us a couple weeks, and we turn the content into a white paper. You can see the last webinar we ran about how your Australian investor property will be taxed now that you're a US resident. Also, we're working on a key financial data sheet for Australian or US individuals. So it will be a single data sheet that contains much of the key data that you're seeing right here. We would really appreciate your feedback on tonight's presentation. Shortly, you'll be receiving an email. Please go ahead and let us know what we can do to improve the value of the content we provide here. And lastly is my contact information along with upcoming travel dates. You can see a couple trips around the United States and to Australia through the course of the rest of this year. Thank you very much. Please feel free to contact me if you are interested in becoming a client. Otherwise, refer to our website or YouTube for further information. It's been a pleasure speaking with you here tonight. Thanks so much.